right, take it away.
Okay. We start with the case. Sorry.
We interrupt this class for an important message from...
That was a cool ring.
Sorry. I don't know who's going. Okay, we start?
Yeah.
Okay, thank you guys for all your help. I don't know if I passed this class. I'm really down. But I try to learn something maybe for the next time I take the same class. And this case is Brentwood Associate case discussion, but it's for the company. The name is Soe Kitchen. And I start with the little resume, what happened in this case. Soe Kitchen started in 1995. It's founded by Soe and Marcus Casimius. Both have a Greek heritage. And this is this idea coming to her mother. It's a fresh, use a fresh garden stuff for cooking. And this guy started the restaurant and running for a couple years. And 2007 introduced the idea to the Brentwood. The Brentwood is a private equity industry, and this guy have a lot of interest in this kind of restaurant, and he invests in this restaurant. And but in 2012, coming this situation, and is sell the company or transfer an IPO. I learned now what is the IPO, and it's initial public offering. And okay, this is the situation, and the question is, if we continue and we sell the company to another investor, or we put this company in the IPO system. Is the IPO is the name in English? You hear me?
Yeah. Usually you say IPO.
IPO.
Yeah, IPO. There you go.
Okay, an IPO, and I don't know. I don't know what I said more.
So, do you want us to, like on question 3 of the case discussion?
Yeah.
Do you want us to vote right now to see which one we should do?
Yeah. Okay.
Okay.
It's we need to decide if Soe Kitchen, what is the best option for Soe Kitchen? We sell or we transfer in the IPO company. What do you think? Aaron, what do you think?
All right. Thanks, Gloria. My suggestion is to sell to a strategic buyer or financial buyer. And then I'll defend my case after I hear what everybody else's decision is.
Okay, I'll give my position. I think that they need to wait a couple of years until they get to a similar size as the other company that they're comparing, Noodles. Because Noodles was like a $200 million company. Yeah, anyway, I think that the valuation in 2 years will be a lot better. I don't see any urgent need to bring in capital right now. It's not like Brentwood's investors are saying, "Hey, we've had this company for almost 6 years. When are we going to get a return on our money?" Because investors, when they get their money back, maybe they'll get 10 times or whatever, but they have to turn around and find somewhere else to invest that money unless they need the cash out for some reason. And I think they would have a better return on that money over the next 2 years than any other type of either venture capital or equity investment that they can make. So that's why I think they've done well, and I think they'll do fine in an IPO. But I think the return on their money over the next couple of years, I don't think they can make a better return than what they could get by keeping it in that company and doing the IPO in 2 years. There's a big question mark. It says there's never been. This would be the smallest IPO for this type of company. I just think there's way too much risk with doing something that's really never been done before, and that's take this small a company public.
I kind of feel the same way. I feel like with their current growth rate, they don't have to just settle with the risk that they have right now. They can just wait a little bit, get bigger, and then do it then, because right now it's just a little too soon. It's I don't know. I really feel like they're going to continue growing, and it's just going to be a lot simpler of a process in a couple of years, to be honest. Just with the rate of growth that they're having right now. So, sorry.
My suggestion is the same. Maybe we need waiting for a couple years more. Now in 2013, what is the time that this case is? The company have 102 units, and we grow up in two more years. The idea is grow up for 30 more restaurants, and maybe got a more it's a more better situation for maybe put it in IPO system.
Go for it, Aaron. Defend your position.
All right. So I guess the advantages I had, and I know most of you guys are for the wait option, so I don't have to defend too hard against the IPO, but I was planning to, so that's where most of my positions come from. So the IPO cost between $10 and $13 million with a financial buyer. There's no high cost. Also, the process is much more efficient. It can be done and settled in about 3 months versus 9 to 12 months of an IPO. The cost, instead of $10 to $13 million, is usually 1.5% of gross price. Legal fees, in addition, would be another $1 million. And Brentwood would be far less dependent on the outcome of the IPO. If the IPO went through, then Brentwood would be sitting pretty. But if it backlashed, I guess, or failed, then Brentwood would take a lot of backlash, and it would damage their reputation and things like that. Also, an IPO would have a lot of transparency in the financials. They'd have to publish quarterly reports and yearly financials. The investors would influence perhaps how the CEO, is it Morris or somebody like that, would run the company, and he doesn't want that extra pressure of doing what's best for the shareholders in the long run versus what's best for the investors, next quarter. So there's hopefully through a private sale he would be able to maintain status as CEO and run the company with the idea that the company exists to make money and the decisions you make are to increase shareholders' value. Versus just making a lot of profit. You could cut expenses by firing all the staff, but a year from now, then your shareholders' value would be zero. So anyway, those are kind of some of the ideas that I had on, and I guess I could share my spreadsheet. It's not formatted very well. I just kind of threw it together before this meeting. But if we're not there yet, maybe I'll wait to do that.
Aaron,
Yeah.
I'm looking to see the thing with the CEO. It said that the CEO, he would have to refine the way he communicated with investors, but it doesn't. Did you see a place where it said he didn't want to be the CEO under an IPO?
No.
Okay.
No, just that he didn't want to have, I think they use the word whipsaw or something like that.
Yeah, with the quarterly results and having to meet expectations of investors.
Yeah.
Okay. Because I was thinking if he was kind of opposed to it, that would be a definite thing. Because I think he's a definite key player that you want to keep in the mix.
I think you brought up some really good points right there. I wonder. I mean, it's a lot simpler of a process, but how much bigger does it need to get for it to really be a good? I don't know. To make a lot more money, in 2 years than getting it, doing it right now with like a private buyer or something like that. I know it's quicker and smoother, but is it going to be as good of a deal for him?
I don't think waiting is a bad idea. It did mention in the case that an IPO, a successful IPO for Brentwood right now would be like a home run.
Right.
To increase their reputation and things like that. But I'm not sure how much bigger it needs to go to have more confidence in a successful IPO. Most of my projections were, I guess, the cost of the IPO and the money they'll make versus the cost of a financial buyer and how much they'll get from the transaction.
Okay.
So what
I had a
did you come up with as far as evaluation? The thing I was looking at was it said with an IPO they would expect a current valuation of 21 times trailing EBITDA versus 8 times for strategic investor or financial sponsors and 13 times for strategic investors. So I think the trailing EBITDA was 11 million. Was that right?
Yes, 11 million.
So 11 million times 21 would be a valuation of 231 million.
And somewhere I had 115 million. But is it 111 million?
111, I think, was the projected revenue for 2013.
Okay.
Yeah, 11 million is the ABT, I don't know, TDA.
So at 8 times, it would be
88.
88 million, and then 13 times 11 would be 143.
Yeah, let me share my screen real quick, Norman.
Okay.
And then maybe we could talk this out real quick. Can you guys, if you click on my name, it won't jump around. You click on the screen every time somebody else talks. So I guess IPO pricing is this chart, financial buyer cost. I just kind of use this formula. I had 2013 IPTA, EBITDA of almost 11 million, and then I just used a multiplier of 13, and I came up with a valuation of 141 million. And so that's kind of my, if they get 13, if they get 20, then it jumps up to 217 million. If it was an average between 11 or 12, 13, and 20, if we round it up to maybe 15 times, so they're in the 140 to 160 million range. Can we agree on that part, maybe?
Yeah.
Okay. And then, so this chart was included in one of the appendixes or exhibits, I guess. And I don't have all the data, but basically the company's revenue when they went public, their offer price, IPO close day, their gross IPO proceeds are in this column, and the evaluation, I think it's equity evaluation, at August 5th of 2013 was, this many times. And I'm not sure what this many times is, if it's the stock price after IPO or if it's the revenue. I'm not sure. I guess let me look that up real quick.
I think it's the earnings before interest, taxes, depreciation.
Okay. Let's see. Sorry, guys. Not that one. All right. So, okay. EV is enterprise value, includes both debt and equity. So I guess this is my question right here. If we take the revenue on 111, which is in million, and I just kind of did an average of the multipliers. A lot of these are like averages of, similar companies. This one also is an average of IPO date. So if I get my justification was if they had an average round of IPO or whatever, then these are the results they were going to get, and I got a multiplier value of 20.2. Maybe I have one too many zeros in there. Okay, so then would that get us the 233 million we're talking of, Norman?
Yeah.
Okay. And then
what I would do, what I'm going to do when I kind of start playing with this is I think we should compare, at least to justify my theory of waiting a couple of years.
Mm-hmm.
What I would want to do is come up with an earnings and EBIT projection at, let's say, the revenue for 2013 was projected to be what, 114 or something.
Yeah, I had in my notes like 115.
Yeah. Okay. So 115, and if they were able to get EBIT of 11 off of 115, what do you think their EBIT would be at, say, 200 million in revenues?
Okay.
So let's say, can they get economies of scale? I know one of the concerns was when they spruced up the menu and the locations and everything, the break-even point went from like 800,000 to 1.2 million or some 1.1 million.
Right.
So I know they've kind of cut into their profit margins by making a consistent presentation to the customer, but I would guess that they would be somewhere around, again, with growth per store as well. I would say that, again, I got to kind of play with the numbers, but let's just say, for argument's sake, that on 200 million, they're at 20 million EBIT. So then you take 20 million times, whatever you want, 20.2 or 21. So you have 20 times 20.2. So then you have a valuation of 404.
Oh, okay, I see.
So just comparing going public now and getting a valuation of 231 versus 404 or 233, somewhere around there. 404 minus 231 equals, so you're talking $173 million, the difference between doing it now and doing it in 2 years.
Sure.
So that's kind of how I made my judgment. I don't know how much Brentwood has into them, but I'm guessing that if Brentwood's going to get 231 out of it, and they usually get 10 times, so 10 times, or 231 divided by 10, so Brentwood's maybe into it for 23 million. So if they cash out now at 231 million, then they'll get like a $200 million profit. If they take that 200 million, what can they get? Let's say they just invested in stocks or something at 10%. Over the next 2 years, they'll make roughly 40 million at 10%. If they don't do the IPO, keep the money in the company, do the IPO later, then instead of getting $40 million by investing 200 million at 10%, they'll get 173 million.
Okay.
And I think there's less risk of having a failing IPO at that higher valuation, at revenues of 200 million and 20 million in EBIT. So that was kind of the numbers behind my thing, but I haven't put together a spreadsheet yet for that. It was just kind of rough.
Okay. No, thanks for sharing that, for sure.
But can they get to 200 million in revenue in 2 years? Can they get to 20 million in profit off of that 200 million? Those are kind of big ifs. It looks like they have a pretty good track record, but that is a lot more expansion. So plus they'll need to increase their credit line with GE to fund the expansion. So just my thoughts.
Thank you. I don't know. Aaron, you have another question, idea, or something for this case?
No, I really think we've kind of covered most of the questions here.
Yeah.
You know, if they exit now, great. If they wait, maybe better. Kind of talked about what can go wrong. And we've kind of talked about what they're worth based on who buys the company or if it goes to IPO or not. I guess one of the questions right at the very end, why would anyone sell to a financial buyer instead of an IPO? Other than the efficiency and perhaps less risk, you know, those are pros of a financial buyer. Can you guys think of any others?
Quicker.
I would be interested in looking at the companies that did sell to, you know, in that mergers and acquisition chart.
Mm-hmm. There was one company called somebody, and they got like 21 times their. Yeah, I think it was Olive Garden's parent company and Red Lobster's parent company bought Gastropub or something at 20 times EBITDA valuation. And so that was kind of the example that led me to be like, oh yeah, this is what these guys need to do, is just sell it, you know, get top dollar, private sale, quick and easy, and move on.
Hey, Aaron, can you pull up Exhibit 9?
Yeah.
Put that on the screen.
Sure.
I'm looking at it on my other computer, but maybe we can look at these. It's almost towards the end.
Oh, you know, it's going to jump pages on me when I rotate it, so hang on. Let me do that first. I'll try to make this a little bigger. Is that okay?
Yeah. So, I mean, there's a bunch of companies in here, like I'm looking at Yard House that was acquired by Darden Restaurants. That one, see, that one did go for 20.2 in a I'm assuming a financial transaction. Is that what you're reading? I mean, a strategic acquirer. So that was a private deal.
Yeah.
So Yard House didn't go public. They just sold to Darden, and they were able to get 20.2. But the one right above them, which is J. Alexander's, went for a multiple of 9. So, you know, maybe you've got to, maybe there is a good case for doing a strategic acquirer. I mean, on average, they are, you know, only 13 times. But, and I mean, there's some really low ones, and there's that really high one. Like McCormick and Schmidt's was 7.9. So, I mean, I guess I just don't have the insight to be able to tell what this is saying.
Oh, okay.
I mean, why didn't McCormick and Schmidt do an IPO?
Sure.
Doesn't seem like they could get much lower. I mean, but maybe I don't know, maybe that's just a realistic valuation of 7.9 times trailing EBIT
Hmm.
for them. Maybe they had a ton of debt.
Their
Who knows?
margin is also the lowest too.
Yeah.
Maybe that plays a factor. I don't know. Trailing. I'm not really sure what trailing EBITDA is, but
That's just it's it's whatever the last um, it's your last profit
okay.
rather than a forecasted profit.
Oh, okay.
Trailing
Your
just means that
your
it's
actual
yeah, it's
achieved or
an
whatever.
actual number.
Right. Yeah, I was hoping that their track record and their I know they're only what oh I guess they started with 19 stores or something, but they're 102 now or so.
Well, they're at 90 and project, and they're going to
190.
be at
Okay.
102 in 2013.
Okay. I was just kind of hoping they're you know a little bit better track record versus Noodles and Company would influence a buyer to pay closer to the 20 times than the 7 or 8 time multiplier. So that was kind of my justification is their track record had proven that they're a profitable company and they could get a lot of money by doing it quick and easy right now.
Something else that would probably help them in this decision, which would mean, which would be like, what else do we need to know about the situation? I think the managing partner said that he had gotten like over 20 inquiries about the company. So maybe he could look at those, the 20 interested partners or investment firms or whoever's interested in this business, and maybe he could sit down with the top three and have them give him some type of valuation. Because if, let's say, he could get what Yard House got, 20.2 multiples or whatever it is, if he could get that with a private offering and save the cost of the IPO, I think that's a viable option. I think I'm going to put that down for my what's the thing? Your strongest alternative to your
Sure.
hypothesis.
Right.
Yeah, I think I'm going to put that down. So solicit private company valuations. Because you can really do that without, any risk to. You could share some. I mean, I guess there would be the risk to that of if it was like some type of competitor that just wanted to, kind of get into the books and see what their numbers were. But I think you could just share really general financials
Yeah.
with them, because maybe it would kind of get into kind of a bidding war with the private companies.
Yeah. There you go.
All right. Well, did you guys get the memo about the instructor docking points if it goes under 30 minutes?
Yeah. Yeah.
All right. Well, we started at 6:51 and it's 7:26, so
We're good.
I think we're good.
I'll see. I got another class here in a couple minutes. Yeah, is there anything else on this one that we need to address at this time? Any
No.
last comments or anything? All right. Well, thanks, Gloria. Norman, do you want to end the recording?
Yeah, let's figure out. I'll stop.